Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler, and he is Evan Barnard hanging out with me here in the studio today on this pre-Father's Day special. Happy Father's Day, everybody.
And happy Flag Day.
And happy Flag Day. See, he's got the hat flag going, and I was so busy this morning. I've been in a 4-hour meeting, then I went and cut the grass. I was like, come on, really, Paul? How much do you have to get done in one day?
We were at it pretty early as well this morning. I was hauling, about 10 wagon loads of mulch, and we were weeding some stuff in the garden and all. And just when we stopped, it started raining down south.
Right.
And so it was great. It was a great start to the day.
Fun stuff. Yeah, so a lot of things to talk about today. Oh, my goodness.
Yeah, nothing going on in the world, is there?
No, not at all. Yeah, things are, mundane. It was funny. I was just talking, Evan and I were just blabbing just about some things. It's just, the investment industry is frustrating always to me. And the thing that I get frustrated at, a lot of the reporting on this whole thing that's been going on has been about markets and what to do, what's been happening. I'm hearing things like the market's in a meltdown. And I'm like, 1%? Are you like, what? That's nothing.
Right.
You have, because it used to be, let's say you had a 1,000-point move in the Dow. It used to be 1,000 points was a big deal. 500 points was a huge deal.
Yeah.
And I think that people are living in the past, that they're thinking about 500 points as being a lot, or 1,000 points being a lot, 800 points as being a lot. It's nothing. It is a blip on the radar screen. Number one. Number two, the other thing is that the reporting on what to do and how to manage money I can't think of, I don't know, Evan, you may be able to think of maybe some companies, some investment providers that don't engage in an active management, stock picking, market timing, but say that they're not doing it. It just seems like it's the industry standard. Either that or it's guaranteed income. Those types of things. So, the guaranteed income people come out of the woodwork when things get a little bit dicey because, you got to protect yourself. You got to make sure you protect your downside. And
the gold people come out.
Yeah, the gold people come out for sure. But, I think guaranteed income, if you had a guaranteed income of $7,000 in the 1970s, you were absolutely rolling. You were doing great.
Right.
Fantastic.
Per year, not per month.
Per year. Yeah, per year. Sorry. Yeah, I should probably be really clear about that. Yeah, but if you have $7,000 now, it's like, can I meet my mortgage payment?
Right.
Can I meet my car payment? Is really what people are worried about now. And you think guaranteed income, you got a problem on your hands. And I don't know of investment firms, especially advertising, locally here, that aren't engaged in annuity sales of some sort for guaranteed income for that. And then on the other hand, you get the investment firms coming out and saying, hey, here's what you need to do based on what's going on. Here's what's happening in markets. I'm going to give you an example in just a second here of what that sounds like, because if you don't recognize the jargon and you don't recognize how they do it, you will be subject to what they're doing. And, and I had somebody say this week, I said, well, Paul, sometimes you get a little negative about, and if you knew something was going to hurt somebody, if you were a doctor and you absolutely knew that cigarettes were just really bad for people, would you get a little negative about cigarettes? Or would you get negative about advertising about cigarettes? You'd probably, if you had any heart, you'd get negative about those types of things.
Well, and frankly, in today's society, let's use the medical example. Let's say that there was, a proven connection, and, we'll use cigarettes as the example, that's bad for your health.
Yeah, something that's not controversial. Sure.
And if the doctor didn't tell you and you got sick or maybe contracted lung cancer, you could sue the doctor for not telling you that it was bad for you. I mean, in some respects, we're protecting ourselves and our clients of saying this isn't good for you.
And in the medical field, that totally flies because there are those standards.
Right.
I'm telling you, in the investing world, the standards do not apply.
There's no standard of care market timing.
No, there really isn't. And it's and you look at the Prudent Investor Rule, the American Law Institute Prudent Investor Rule. I've talked about that before. If you never heard me talk about that before, I have a whole thing on. Oh, gosh, I actually have it in front of me, believe it or not. And it was a restatement, and I'll read from it for those of you who have not heard this, because you need to hear this. The restatement is a guide for practitioners of law, trustees, investment advisors, as well as a source of legal authority. It is recognized that trust law is most often applied to trust practice as distinct from litigation and concerning trust administration. And it talks about risk reduction through diversification. It talks about how, and there are two different types of diversification. Diversifying within an asset category, not just owning one large U.S. company or a handful of, let's say, tech companies. Let's just use that as an example, because I was actually analyzing a portfolio this week, and the lady had many different funds in the portfolio, a lot of different funds, and some individual stocks. Well, the interesting thing was the funds all were holding mainly tech stocks, large growth companies, and those same growth stocks were held individually as well. And so you say, well, I could diversify amongst all tech stocks, but the reality of it is that when tech stocks drop 80% like they did 2000 through 2002, you're not protected. There's a problem right there.
Yeah.
Then it goes on to say in the Prudent Investor Rule, active strategies entail investigation and analysis and expense that tend to increase general transaction costs, including capital gains taxation. Then it goes on to say that market efficiency from an economic perspective is say the evidence shows that the typical investment perspective, the major capital markets of this country are highly efficient in the sense that available information is rapidly digested and reflected in market prices. News comes out, in other words, and it gets reflected in stock prices. That's the way this stuff works. And information is rapidly digested. It shows up. As a result, fiduciaries, what do you hear advertised? We're a what? Fiduciary. That's what they say. Evan, this is making a great commercial now I'm thinking about. This ought to be in a commercial. I ought to just read this.
There you go.
Fiduciaries are confronted with potent evidence. Now, notice that they say fiduciaries absolutely cannot engage in this practice. It doesn't say that. They're just confronted with potent evidence.
AKA overwhelming.
Oh, yes. Potent,
robust.
Yes, robust, potent evidence that the application of expertise, investigation, and diligence in efforts to beat the market or get out of the market before it's going to go down, get in the market before it's going to go up, ordinarily promises little or no payoff, or even a negative payoff after taking into account research and transaction costs, after taking into account the expenses that you incur to pay these people to do this thing, that there's potent evidence that it doesn't work. Okay, so you see what I get fired up about this stuff. Empirical research supporting the theory of efficient markets reveals that in such markets, skilled professionals have rarely, but it's not never.
Right.
And that's why they get away with it. Have rarely been able to identify underpriced securities, that is, outguess the market with respect to future return with any regularity. In fact, evidence shows that there's little correlation. But there's some that did it. But wait till the next sentence. There's some that did it. There's some that had better returns than the market. Oh my goodness, we can't say that this is a stupid thing to do. There's some people that did it. Wait. In fact, evidence shows that there's little correlation between a fund manager's earlier successes and their ability to produce above market returns in subsequent periods.
Right.
But you can call yourself a fiduciary, engage in this garbage. So hence, I guess there's not many, but there's this one, and I get fired up when even one person gives me any kind of grief about engaging in this type of, Paul, you're getting a little negative there. I'm trying to protect people.
Right.
I feel like I've got to do this. This is important. Don't gloss over this. Okay. So, we have a little bit of activity overseas this week.
Teeny bit. Yeah.
Yeah, you think? I mean, Evan?
I would absolutely say we had some activity.
Okay, so what happened? We hear the news people saying, it's a meltdown. It's terrible. The market's plummeting, blah, blah, blah. And I'm like going, 1%? Really? But, you go on the financial channels, and they did say it's not really a whole lot going on here. To their credit, they said that. But let's just check out what they did say and as to why there was such an underreaction.
We've been talking about, the possibility of a wholesale attack on Iran's nuclear enrichment facilities for years, and the fact that the response in the market is about a little over 0.5% on the S&P, I would assume is something of a surprise in terms of how little decline we're having.
I mean, I guess it's a surprise on a headline level.
Now, number one, before I go on, 0.5% at that point.
Yeah.
And he's like, well, we've been expecting this for years. So is it baked in? Is it that point right there that in the prudent investor rule being made that available information is rapidly digested and reflected in market prices?
Yeah.
That line right there. Was it already baked into the goods that this could happen? I mean, what do you think, Evan? I mean,
I think that it is viewed by a lot of people as an inevitability. Mm-hmm. Whether it was a missile attack, drone attack, whatever, that there was going to be some kind of hostility. Mm-hmm. And I think the market, which, it reflects the opinions and behaviors of 8 billion people, not just investors, but consumers as well, drive market prices.
Sure.
And
because your consumer sentiment can drive what
or you just
analysts
quit,
think
you
that
quit
is
buying
going to
gas
happen.
or whatever the deal is.
Sure.
And particularly with the last several days, it's a little bit like the market trying to anticipate or be on the edge of their seat for the next Fed interest rate move.
Right.
You have this, we're removing our non-essential personnel from embassies. I mean, there was some information that gave people more reason to say, okay, it might be sooner than later.
Right.
Still don't know when. And, to me, and you may have some more bites on this, but to me, let's just say it was a 1% move based on the attacks.
Yeah, okay, sure.
Makes it easy. And this is, the potential start of World War III, all that kind of drama. Mm-hmm. J.M. Smucker Company, that non-tech, Twinkies, Hostess cakes, jelly, peanut butter, missed its earnings report, and it dropped 16.5% in
there you go.
an hour.
There you go. There's perspective for you.
So there's, okay, that was caught people completely off guard. Then you're going to have a big move. And again, it's representative to the prudent investor rule that you're reading. News is what drives the market. No one knew what was going to happen. And the second it came out, it's like falling off a cliff. It's really scary.
Oh, yeah, exactly. So, going on, here was the response.
It's a surprise on a headline level based on how momentous the kind of chain reaction could be from here. But I think right now, if it's going to be, isolated response, and there's all these impediments to it becoming a broader conflict, I'm not surprised that the market, already on firm footing, is going to try to underreact to it, at least initially here.
Yeah, because there is a great possibility that things will work out, and that it was expected, that the response is expected, that that what is going to happen eventually is people are going to are going to say, hey, wait a minute, we don't want to go too far here. Number one. Mm-hmm. Number two, it's an area of the world that has always been a powder keg. Yeah. I don't know that there has ever been a period in history where that area has been long predicted.
At least
that it was going to be that way.
Yeah.
Right. Exactly. I mean, it's just like, so there's nothing really new. But that doesn't stop the investment firms from coming out and saying, what do we think is going to happen here? And that's exactly what Citigroup came out. One of the guys from Citigroup actually came out and said, here's our analysis of it. Now, this is just one of many. I mean, I literally could go dozens and dozens and dozens of huge banks and investment firms that would have an opinion, but I'm just choosing one just to give you an idea of what to listen for. This is the type of stuff that you hear.
Scott Kroner joins us, Citigroup U.S. equity strategist. He's here at Post 9. He raised his year-end S&P target to 6,300 this week from 5,800. So
this guy comes out and he raises what he thinks is going to happen in the S&P 500. Number one, that's how she starts the whole segment. This person comes out with some prediction that the market's going to jump like crazy, and he has the bad fortune of being interviewed on the day after this happens. But anyway,
kind of catching up with the market here, I guess, as we continue to make new highs, although a step back today. How do you think that what happened overnight impacts the U.S. equity market, if at all?
Yes, Sarah. So the way we've been talking about it is, okay, great. We pushed our target higher, 6,300, roughly 5% upside in the second half of the year. Got that. We know that we're going into this with a close to overbought condition on the NASDAQ at least, to a certain degree the S&P, and volatility.
Now, number one of the things he talks about right there, interestingly, overbought.
Right.
And that's a word that you'll hear when you're thinking in terms of someone that is believing in market inefficiency, which is the opposite of what the prudent investor rule is talking about.
Right.
Because they're making the assumption that it's mispriced, it's overpriced. But, I think that's a good point, just because when you say overbought, could he be right? Yeah, absolutely could be. Historically, we see run-ups in market segments like we've seen in that particular area that he's talking about. And yet that is where most American investors have the most amount of money. That's where they have the majority of money. I can't remember the last time I've analyzed a portfolio that I didn't see that area overheld.
Right.
So overbought and it's overheld. I mean, I almost sounds like I'm agreeing with him.
Right.
But I'm just saying that they have too much of a concentration in that particular area. But anyway.
It's come down quite a bit. You see that in the VIX levels, which have begun to come off the bottom recently. So what we had said was this is probably not going to be a year of some results.
So VIX is just talking about the volatility levels. Volatility levels coming up some. All right.
There's going to be ongoing volatility metrics that come into play, whether it's policy related. Now we have geopolitics coming back into the equation here.
Now, I love that. He's predicting market volatility. Yeah. Evan, oh my goodness. What do you think about that?
I was writing down ongoing volatility on the note.
Yeah, we think alike.
It's just, when have we never had ongoing volatility? It's like rain is going to continue to fall from the sky as opposed to raise up from the grass. Oh, okay.
Yeah.
Got it.
And if it weren't for volatility, markets would give you the returns of CDs.
Stocks that get you 1%.
Right, exactly. You would get no higher return than you would with, fixed income investments. So it's just funny that he says that.
There was one piece in an earlier clip that you had played.
Okay.
And it kind of jumped out at me just because of how they used it is, the market does not have a mind. The market doesn't have thoughts.
Are you talking about the Burton Malkiel thing? The market doesn't have a memory?
No, they were basically saying I think the clip was the market is trying to respond to this.
Uh-huh.
Well, the market is just a place where transactions occur.
Yeah.
Investors and institutions and buyers, they're the ones driving that behavior. But I think it is oftentimes we kind of view that the market just acts independent of all the people buying and selling
They personify
stocks.
the market, yeah. Yeah, for sure. That's funny. That is so true.
Our presumption when we usually look at these types of activities is obviously where the path you go is escalation or not. But from there, it's like starting point for us is what's the impact going to be on global macro conditions? What's global GDP going to do as a result of this?
Okay, so he's looking at it and saying, hey, what's going to happen? Macro, I mean, big picture, macroeconomics. What's going to happen geopolitically all across the globe? I mean, you're biting off a big piece of pizza right there when you're trying to figure out
That's
how
a lot
the
of
entire
variables.
Yeah, that's a lot of variables to try to figure out how this is all going to play through. And that's why this is so frustrating and so hard for any investment manager to do it, because there's just too much.
Okay, and that, we'll see more on that, but my guess is probably limited. What that then does in my framework is come back to probably not a massive influence on underlying S&P fundamentals. Bottom line, initial take here is be prepared to buy volatility-related weakness.
There you go. So what are we going to do? What do we call that, Evan? Being prepared to buy volatility-driven weakness.
I'll take market timing for 500, Alex.
That's my son's name, but no, exactly.
Or whoever replaced him.
I don't know. I don't watch it.
Yeah, the guy
was
that
it
did
Alex Trebek or something? I don't know.
Alex Trebek is who used to do it. I forget who replaced him.
So yeah, I'm glad I even know that much. But anyway, so there it is, right there. There is the state of investment management in the United States. So she has a really interesting comeback, because he's trying to downplay, right? Oil and all of that, right? So we can't let a crisis go to waste on financial channels, can we? So when we come back, let's talk a little bit about, or hear what the response was regarding his comments about oil right there. You're listening to the Investor Coaching Show because it's funny. It's instructive. All right, back here on the Investor Coaching Show, Paul Winkler along with Evan Barnard, and talking about, this week we had the big news, Iran, Israel, back and forth. What's it going to cause? The market went down just a teeny bit. Compared to historic norms, that was nothing. It was a blip on the radar screen. That's not to say it won't go down further, or it could bounce back up. You just really don't know. But there are all kinds of thoughts about what's going to happen next, predictions, the big investment firms coming out of the woodwork. And that's what people think that they want an investment manager to do. Hey, protect me from market downturns. Downside. A downcern is a cross between downside and downturn. In case you're just wondering right there, as my mind is on downcern.
Put that in the Urban Dictionary next year.
Yeah, I got my Merswixed, as I like to say. Okay, so there was this whole thing about, what's going to happen. Oil, it's not a big deal, blah, 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 blah. It's in, of course, the media many times says, oh my goodness, we got to make a calamity out of this thing. We got to really stir up some concern about this. So the response to the prediction was kind of funny as well, just in a different way. It was just really the same thing. Shouldn't we be concerned? Shouldn't we be scared?
Well, 7.5% move on oil prices is not nothing. I mean, there are those who worry about sort of 1970s style stagflation. We've got tariffs coming in,
Now, 7.5% move, that's not nothing. Agree, for sure. Yeah, that isn't nothing. But, when you have moves in oil prices like that, and it can happen pretty quickly. And think about it this way. If you have to change suppliers for things, or you have to change what you're doing, you could have a temporary change in the price of oil, the price of production of energy, and those types of things. And it could be that you have to change suppliers. You have to change where you're getting it from. Think about, the United States, and we were net exporters, right, pretty significantly of oil. And then we slowed that down. Do you just start to build that back up? That's not an overnight thing.
Right.
But, the idea, oh my goodness, this is terrible. This is, this has turned on a dime, and this is scary. We ought to be worried about this.
Seen an inflationary impact there yet, but if we do see a sustained move higher in oil, is that a concern?
At some level, it's a concern. It's going to be the sustainability.
Oh, let me go back. She said something else that I need to address there. I didn't even think about it until after I was like, oh, wait. What did she say about what this looked like? She talked about 70s style oil. Now, if you look at what happened in the 1970s, some of you older people that have been around the block a while, you've been around here. If you're, under the age of like 40, maybe this is something it wouldn't even register for you, or under 50, I guess. But you think about during that period of time when you heated your house, you drove your car, when you did anything, you ran your manufacturing firm, you ran your company, you ran, machinery of any type. What was it driven by? It was all fossil fuels, quote unquote, as they like to call them. It was all driven by oil. So that was a huge deal. It was the only game in town when it came to energy sources back at that point in time. You didn't have. Did you see the thing about Toyota, Evan?
I did not.
Oh yeah. So Nick is nodding his head like crazy. Yes, I've been talking about it here on the show for a little while. I think they're getting doggone close to a hydrogen-driven vehicle.
Oh, good.
I think it's really, really getting close. And I saw something out there regarding that they think that they got this thing down. I mean, stick water in a vehicle and drive it. That to me that's exciting stuff.
The Hindenburg was filled with hydrogen too. So.
But okay, you went there. All right. So you look at what they did with the tanks on these things. I mean, the tanks are just—it's not a little, dirigible with little thin
canvas.
Yeah, canvas. I mean, we're talking about some seriously thick. The tanks that this stuff goes in. But anyway.
Well, we have nuclear, too. There was more nuclear after all of that going on.
Well, sure. Yeah, no question. Absolutely dead on right. So, you look at that and go, wow, 70s, we were so dependent upon oil. And she's going back to there. And I'm thinking, is this even a valid comparison?
Of it is there's always be careful what you wish for on this. So, and when we look at our S&P earnings profile, for example, started the year looking for 270. We're now at 261 and we had come down. Wouldn't you know, the energy sector has been the biggest drag on S&P earnings versus where we started the year. So, so what you end up potentially get here some relief on the fundamental front for that part of the market. I completely get the...
And that's an interesting thing. You think about it. When you invest, you may have something that you think, wow, if we have a reduction in cost for energy, then that's going to be great for everybody. And it is, but it's a negative for those companies. And if you own a lot of them, you got a problem on your hands if you own a lot of those. And, there are investment firms that go out there and concentrate on this stuff. There are funds. That's what they do. There are funds that do nothing but that. And if you made a bet that was the area to be, then you end up being severely disappointed when that area is hurt more than others.
Inflation read-through. Again, that's going to have to be a little bit more of a protracted higher oil price setup, and there's been a lot of discussion about still many sources of supply to be tapped into. So we're not going to stretch too far in terms of presuming a persistently higher oil price at this point, but certainly that's going to be on the radar.
And that's the point right there, is that we have other sources, and there are other things that can be turned to, and the media, the talking heads will often go, well, what if this happens? And that appeals, people's anxiety kicks up, and it attracts viewership, it attracts listenership, but it's detrimental to investors who tune into this stuff, hoping that they're going to get what? What is it? Why do we tune in? And it's, if you think about it, it's the desire for a prediction about the future. What's going to happen? Where is this going to go? What should I do to protect myself? And recognizing this in ourselves as the first step, really, to helping protect ourselves from ourselves. Because we tend to be the biggest enemy of good investing. We tend to be our own worst enemy.